Listen, I don't care if this makes you uncomfortable. I care about whether you're going to lose $300,000 in lifetime Social Security benefits because you don't understand the rules. And right now, if you're approaching retirement without a strategic plan for when and how to claim Social Security, you're about to make mistakes that will haunt you for the rest of your life. I'm Charles Wellington, and I've been a retirement planning specialist for 38 years. I've helped thousands of clients navigate Social Security claiming strategies, and I've watched just as many people make catastrophic errors that cost them hundreds of thousands of dollars because they didn't know the rules, didn't understand the math, or listen to bad advice from people who should have known better. What I'm about to reveal will shock you because I'm going to expose 5 Social Security mistakes that are costing Americans billions of dollars in lost benefits every single year. Mistakes that are completely avoidable if you just understand how the system actually works. Before I reveal these 5 devastating mistakes, I need you to do something. If you're within 15 years of retirement, if you're already collecting Social Security, or if you care about maximizing every dollar you're entitled to, hit that subscribe button right now. Smash it. This channel is dedicated to helping you keep more of your money and avoid the traps that destroy retirement security. We deal in facts, mathematics, and strategies that actually work. So subscribe. Join this community because what I'm about to tell you could literally be worth hundreds of thousands of dollars to you and your family. Let's get something straight right now. Social Security is the most important financial decision you will make in retirement. It's not optional. It's not something you can fix later. The decision you make about when to claim benefits is permanent. You get one shot, and if you get it wrong, you will pay for that mistake every single month for the rest of your life. Here's what makes me furious. The Social Security Administration doesn't educate you properly. Your employer doesn't teach you the strategies. Most financial advisors don't understand the nuances, and the result is that millions of Americans are leaving massive amounts of money on the table. I'm talking about real money, not hypothetical projections, not marginal differences. I'm talking about $250,000 mistakes, $500,000 mistakes for married couples, money that you paid into the system your entire working life, money that you're entitled to, money that you're forfeiting because you don't know the rules. I'm going to walk you through 5 specific mistakes that are costing people fortunes in Social Security benefits. I'm going to show you the exact math. I'm going to give you real examples, and I'm going to tell you what you need to do to avoid these errors. Here's the thing about Social Security. It's not just a retirement benefit. It's a complex financial instrument with rules about timing, spousal benefits, survivor benefits, taxation, earnings limits, and cost of living adjustments. And if you don't understand how all these pieces fit together, you're going to make mistakes. You know what keeps me up at night? It's sitting across from a 70-year-old couple who claimed Social Security at 62 because they wanted to get their money while they could, and showing them the calculation of how much they've lost. Watching their faces when they realize they gave up $400,000 in lifetime benefits, and there's nothing they can do about it. The decision is irreversible. That's not going to be you, because I'm going to give you the information you need to make the right decision. But before I reveal mistake number 1, you need to understand something. Social Security is not going bankrupt. Despite all the fear mongering, the system will continue to pay benefits. Even in the worst case scenario, it will pay about 75% to 80% of scheduled benefits. So making claiming decisions based on fear that the system will collapse is a mistake in itself. Are you ready? Are you ready to see the 5 mistakes that are costing people hundreds of thousands of dollars? Good. Let's start. This is the single most expensive mistake Americans make with Social Security, and it's the most common. Approximately 40% of people claim Social Security benefits at age 62, the earliest possible age. Here's why that's usually wrong. When you claim at 62, your benefit is permanently reduced by about 30% compared to waiting until your full retirement age, FRA, which is 66 or 67, depending on your birth year. And if you wait until age 70, your benefit increases by about 24% to 32% beyond your full retirement age benefit. Let me put that in real numbers. Let's say your full retirement age benefit is $2,500 per month. If you claim at 62, you get about $1,750 per month. If you wait until 70, you get about $3,100 per month. That's a $350 per month difference. Over 25 years, that's over $400,000 in additional lifetime benefits. But people don't see it that way. They think, if I take it at 62, I'll get 8 years of payments before I reach 70. That's $168,000. I'll come out ahead. And in the very short term, that's mathematically true. But Social Security isn't designed for the short term. It's designed to protect you from outliving your money. Here's the break even analysis. If you claim at 62 instead of waiting until 70, you break even at around age 80 to 81. After that, every month you live, you're losing money. And the average 62-year-old American is going to live into their mid 80s, women into their late 80s. So if you claim at 62 and you live to 85, you've lost approximately $270,000 compared to waiting until 70. If you live to 90, you've lost over $450,000. That's not a hypothetical. That's actual money that you will not receive. But here's what really kills me. Most people claim at 62 for emotional reasons, not financial ones. They claim because they're afraid Social Security will run out. They claim because they don't trust the government. They claim because they want to enjoy their money while they're healthy. These are not financial decisions. These are fear-based decisions that cost hundreds of thousands of dollars. Let me give you a real case. I had a client, a woman named Patricia, who came to me at age 63. She had claimed Social Security at 62 against my advice because her neighbor told her, "You better get yours before it's gone." Her benefit was $1,680 per month. If she had waited until her full retirement age of 66, she would have gotten $2,400 per month. If she had waited until 70, she would have gotten $368 per month. Patricia is now 75 and in excellent health. Her mother lived to 94. If Patricia lives to 90, she will have forfeited approximately $383,000 in benefits by claiming at 62 instead of 70, and there is nothing she can do about it. The decision is permanent. Here's the rule you need to understand. Unless you have serious health issues that suggest you won't live past 75, or unless you absolutely need the income and have no other resources, you should delay Social Security as long as possible. Every year you delay from 62 to 70 increases your benefit by 6.5% to 8%. That's a guaranteed return you cannot get anywhere else. This mistake costs married couples massive amounts of money because they don't understand how spousal and survivor benefits work. Here's what most couples do. They both turn 62, they both file for Social Security, they both take the reduced benefit, and they think they're maximizing their household income. Wrong, dead wrong. Here's what they should be doing. In most cases, the higher earner should delay as long as possible, ideally until age 70, while the lower earner might claim earlier. Why? Because of survivor benefits. When one spouse dies, the surviving spouse gets to keep the higher of the two benefits, not both, the higher one. So, if you're both collecting reduced benefits, the survivor is stuck with a reduced benefit for the rest of their life. Let me show you the math. Let's say the husband's full retirement age benefit is $3,000 per month and the wife's is $1,200 per month. If both claim at 62, the husband gets about $12,100 and the wife gets about $840. When the husband dies at 80, the wife steps up to $2,100 per month for the rest of her life. But here's the better strategy. The husband delays until 70 and gets $3,120 per month. The wife claims at 62 and gets $840. When the husband dies, the wife steps up to $3,620 per month. That's $1,620 per month more than in the first scenario. If the wife lives another 15 years after her husband dies, that's an additional $291,600 in survivor benefits just from coordinating the claiming strategy. But wait, there's more. If the lower earning spouse claims early while the higher earning spouse delays, the household is still getting some Social Security income during those years. You're not living on zero while waiting. You're getting the lower earner's benefit, which helps cover expenses while the higher earner's benefit continues to grow. Here's a real example. I worked with a couple, Robert and Linda. Robert's benefit at full retirement age was $2,800. Linda's was $900. Robert wanted to claim at 62s because he was tired of working. I showed him the numbers. If both claimed at 62, Robert gets $1,060, Linda gets $630. Household income, $2,590 a month. If Robert waits until 70 and Linda claims at 64, Robert eventually gets 3,472, Linda gets 720. When Linda is 70 and Robert is 72, household income is 4,192 a month. The difference? Over a 25-year retirement, that's approximately $480,000 in additional benefits, just from coordinating when they claimed. But here's the mistake I see constantly. Couples claim together because they don't understand the survivor benefit rules. They think they're both going to live to 95 and collect two benefits forever. But statistically, one of them will die first. And when that happens, the household loses the lower benefit and keeps the higher one. If you're married, you need to think about Social Security as a joint decision, not two individual decisions. The higher earner's benefit should be maximized because it becomes the survivor benefit. The lower earner's benefit is more flexible. Here's something most people don't realize until it's too late. Social Security benefits can be taxable. Up to 85% of your benefits can be subject to federal income tax depending on your other income. Here's how it works. The Social Security Administration calculates something called combined income, which is your adjusted gross income plus tax-exempt interest plus half of your Social Security benefits. If your combined income exceeds certain thresholds, your benefits become taxable. For single filers, if your combined income is between $25,000 and $34,000, up to 50% of your benefits are taxable. Above $34,000, up to 85% of benefits are taxable. For married couples filing jointly, the thresholds are $32,000 and $44,000. Let me show you why this matters. Let's say you're married. You're both collecting Social Security, and your combined benefits are $48,000 per year. You also have $40,000 in IRA distributions and $5,000 in investment income. Your combined income is $69,000, $45,000 in non-Social Security income plus $24,000, which is half of your Social Security. At $69,000, up to 85% of your Social Security benefits are taxable. That's $4,800 of your $48,000 in benefits subject to tax. At a 22% marginal rate, you're paying about $8,176 in federal taxes on your Social Security. Many people never see that coming. But here's where strategy matters. If you can control when and how much you withdraw from IRAs and 401ks, you can minimize the taxation of Social Security benefits. This is where delaying Social Security while drawing down retirement accounts in your early 60s can make sense. Here's the strategy. Retire at 62, don't claim Social Security yet, live off your IRA 401k for the next several years. Yes, you're paying tax on those withdrawals, but you're not paying tax on Social Security yet because you haven't claimed it. Then at 70, you claim Social Security at the maximum benefit. At that point, you can reduce or stop IRA withdrawals because your Social Security income is higher. And because you drew down the IRA earlier, your required minimum distributions, RMDs, at age 73 are lower, which means less combined income and less taxation of Social Security. Let me give you a real example. I had a client, George, who retired at 63 with $800,000 in his IRA. His Social Security benefit at full retirement age would have been $2,600 a month. Strategy 1, the wrong way. Claim Social Security at 63, withdraw $30,000 a year from IRA. At age 75, his Social Security is $2,240 a month, $28,080 a year. Due to early claiming reduction, his IRA is now $650,000 and his RMDs are about $26,000 a year. Combined income is high, Social Security is heavily taxed. Strategy 2, the right way. Don't claim Social Security until 70. Withdraw $60,000 a year from IRA from age 63 to 70. At age 70, claim Social Security at $3,224 a month, $38,688 a year. His IRA is now $380,000. At age 75, his RMDs are about $15,600 a year. Combined income is lower, less Social Security is taxed, and his lifetime benefit is higher. Over a 25-year retirement, Strategy 2 results in approximately $220,000 more in after-tax income, just from understanding the taxation rules and coordinating claiming strategy with retirement account withdrawals. This is where the Social Security rules get complex, and it's where people leave enormous amounts of money on the table. Here's what you need to know. If you're married, you can claim a spousal benefit equal to 50% of your spouse's full retirement age benefit. But here's the catch: the spousal benefit is only 50% if you claim at your full retirement age. If you claim earlier, it's reduced. Let me explain with numbers. Let's say your spouse's full retirement age benefit is $2,800. At your full retirement age, you can claim a spousal benefit of $1,400. But if you claim at 62, the spousal benefit is reduced to about $980. Now, here's where people make mistakes. Many people don't realize they're entitled to a spousal benefit at all, or they claim their own benefit without checking if the spousal benefit would be higher. Here's a real case. I worked with a woman named Dorothy. She had worked part time for most of her career. Her own Social Security benefit at full retirement age was $850. Her husband's benefit was $2,900. Dorothy claimed her own benefit at 62 and received $595 a month. What she didn't know was that she could have claimed a spousal benefit instead. At her full retirement age, the spousal benefit would have been $1,450. Even at 62, the reduced spousal benefit would have been $1,015, which is 70% more than what she was actually receiving. Dorothy had been collecting the wrong benefit for 4 years before she came to me. She had already lost approximately $20,000, and that loss would compound over the rest of her life. Total estimated loss over $200,000. But here's where it gets even more complex: divorced spouse benefits. If you were married for at least 10 years and you're currently unmarried, you can claim benefits based on your ex spouse's earnings record. And here's the amazing part: your ex spouse doesn't even need to know. It doesn't reduce their benefit, it's completely independent. I've had clients who were divorced 30 years ago, remarried, and divorced again, and they're now entitled to benefits on multiple ex spouses' records. You can choose the highest one. Let me give you an example. Sarah was married to her first husband for 12 years. They divorced. He went on to become a successful executive. Sarah remarried, was married for 8 years, then divorced again. She worked part time, and her own benefit is $720 a month. Her first husband's benefit is $3,400 a month. Sarah is entitled to a divorced spouse benefit of $1,700 a month, 50% of his full retirement age amount, more than double her own benefit. But she didn't know this rule existed. She was collecting $720 when she could have been collecting $1,700. Over a 20-year retirement, that mistake cost her over $235,000. Here's the rule: if you're divorced, if you were married for at least 10 years, and if you're currently unmarried, check whether you're entitled to divorced spouse benefits. You can call Social Security or use their online tools, but you have to ask. They won't automatically tell you. This one destroys people who claim Social Security before full retirement age and then continue working. Here's the rule: if you claim Social Security before your full retirement age and you continue to earn income, there's an earnings test. In 2024, if you're under full retirement age for the entire year, Social Security deducts $1 from your benefit for every $2 you earn above $22,320. Let me show you what that means. Let's say you claim Social Security at 63 and your benefit is 1,800 a month, but you also work part-time and earn 40,000 a year. You're $17,680 over the earnings limit, $40,000 minus 22,320. Social Security withholds $8,840 from your annual benefits. That's about 7 months of benefits that you don't receive. But people don't know this. They claim Social Security because they want the extra income, then they keep working to supplement that income, and Social Security claws back the benefits. They end up with less money than if they had just kept working and delayed claiming. Here's a real example. Michael retired from his corporate job at 62 and claimed Social Security. His benefit was $2,100 a month, but then he got bored and took a consulting job earning $50,000 a year. He was $27,680 over the earnings limit. Social Security withheld $13,840 in benefits. He lost more than 6 months of payments. Michael kept the consulting job for 4 years. Over that time, he lost approximately $55,000 in Social Security benefits due to the earnings test. If he had simply delayed claiming Social Security until he stopped working, he would have avoided the earnings test entirely, and he would have received a higher benefit when he did claim. Now, here's the nuance: the money withheld due to the earnings test isn't lost forever. When you reach full retirement age, Social Security recalculates your benefit to account for the months when benefits were withheld, so you do get some credit back, but it's still not a good deal. Why? Because the recalculation is based on the reduced benefit you claimed early, not the higher benefit you would have gotten by waiting. You're recouping pennies on dollars you lost. Here's what you need to know. If you're going to continue working and earning more than $22,320 a year, do not claim Social Security until you stop working or until you reach full retirement age. The earnings test goes away at full retirement age. Once you hit FRA, you can earn unlimited income without any benefit reduction. But before full retirement age, if you're working, delay claiming. It's that simple. So those are the 5 devastating Social Security mistakes. Claiming at 62 without running the numbers. Married couples claiming simultaneously without coordinating, ignoring the taxation of benefits. Not understanding spousal and divorced spouse benefits, and continuing to work while collecting early benefits without understanding the earnings test. Every single one of these mistakes is costing people tens of thousands to hundreds of thousands of dollars in lost lifetime benefits. Now, here's what you need to do. First, go to ssa.gov and create a My Social Security account. You need to see your earnings history and your estimated benefits at different claiming ages. This is free. Do it today. Second, run the numbers. Don't guess. Don't rely on what your neighbor did. Calculate your break-even age. Calculate your lifetime benefits under different scenarios. Use the Social Security calculators available online. Do the math. Third, if you're married, coordinate with your spouse. Think about survivor benefits. Think about who should claim when. This is not 2 separate decisions. It's one household decision. Fourth, understand the tax implications. Model different scenarios. See how claiming Social Security interacts with IRA withdrawals, pensions, and other income. You might save tens of thousands in taxes over your lifetime. Fifth, if you're divorced and you were married for at least 10 years, check whether you're entitled to divorced spouse benefits. This could be a 6-figure difference. And sixth, if you're going to keep working, understand the earnings test. Don't claim early and then lose benefits because you're earning too much. Here's what successful retirees do. They treat Social Security like the most important financial decision of their retirement, because it is. They educate themselves, they run the numbers, they get professional advice if needed, and they make strategic decisions based on math, not emotion. Here's what unsuccessful retirees do. They claim at 62 because they're scared or impatient. They don't coordinate with their spouse, they don't understand the tax rules, they leave spousal benefits on the table, and they lose hundreds of thousands of dollars over their retirement. You know what separates these 2 groups? Information. That's it. The rules are the same for everyone. The strategies are available to everyone. The calculators are free. The only difference is who takes the time to learn and who doesn't. I've been doing this for 38 years. I've seen the same mistakes over and over, and every time it's heartbreaking because these mistakes are completely preventable. If this video opened your eyes, if you realized you need to reconsider your Social Security strategy, I need you to hit that like button right now. I need you to share this with everyone you know who's approaching retirement, because this information is worth hundreds of thousands of dollars. And subscribe to this channel. This is where we give you the strategies that actually work. This is where we break down complex rules into actionable information. So here's my final message. Social Security is not something you wing. It's not something you do because everyone else is doing it. It's a permanent, irreversible decision that will affect your income for the next 20, 30, even 40 years. You get one shot. Make it count. Run the numbers. Understand the rules. Make strategic decisions based on your specific situation, because at the end of the day, this is your retirement security we're talking about, and nobody cares more about your financial future than you do. I've given you the information, the mistakes to avoid, the strategies to consider. Now it's up to you to take action. Don't be the person sitting in my office at 70 realizing you gave up $300,000 because you didn't understand the rules. Be the person who made informed decisions and maximized every dollar you're entitled to. Your future self will thank you. Thank you for watching. Now go run those numbers.